making some serious moves up to 1900 for the first time in quite some time. We'll chat on gold for a little bit, and then Bitcoin. Speaking of things that have been moving up, what are you feeling about it? How are you thinking? Because it's making a move, and you're starting to wonder if this is the one or not. In the meantime, welcome to the most dangerous show on the Tasty Live Network. It's Engineering the Trade. I'm Jamal Chandler. We got a quietly booming market today. Move was priced at 2.2%, right? We talked about that heading into this event. CPIs have been some of the more volatile events in the market over the last 6 months, but today is a little muted. I mean, when you look at it, we've done about, I don't know, let's see, what kind of range have we had on today? I think we've had a 50 handle range in the S&P 500 futures. We've had a 57.75 point range in S&P 500 futures. Let me see what that calculates to. About, well, certainly not 2%, but, let's see, divided by 4, let's call it 4,000, right? 1.4, that's pretty muted. That's way under the move that we expected to see, that we've been seeing. I mean, honestly, most of these have been around the 1.8 to 2.3% expected move on CPIs, and they've been going way over as far as the move. I mean, we've seen 4 and 5% moves on this single day. Today is fairly quiet, but it was good overall. Let's move to the slides. Let's chat a little bit. It was essentially a situation where we've seen services kind of calm down on the inflation report. We've also seen energy calm down on their inflation report. And I think that's what's leading to the 6th consecutive month of CPI calming down. Now, what does this do? Well, it means that the Fed is fulfilling their promise. It means that the rate hikes are working. It sucks for your credit cards. It sucks for some real life stuff, but it's better probably than where we were about 6 months ago. And so you're starting to see the market sort of digest this news. This morning was crazy. It was very choppy, as you saw, I'm sure. Markets were moving pretty much all over the place. Everything was trying to find its footing. You see a lot of intersecting trades. You see people trying to put hedges on. You see, all these different things. Different sectors were moving around. But overall, the market likes the news, it would seem. I mean, yields are down, which is one of the main reasons I think that markets are up, and the dollar is down, right? These are all things that we expect. But what does it mean going forward? What does this really mean? Well, one of the things we've been talking about for months is not only inflation, but eventually jobs, right? These jobs reports we've been looking at. By the way, we had initial jobless claims today. It was lower than expected. So not as many people are filing for unemployment, which overall really is a good thing. But with regard to the market, it means that the Fed still has more room to go ahead and do rate hikes. Now, they're not going to do the big ones. They're not going to do the 75 basis point hikes anymore, probably. They're all probably going to be the 25 basis point variety. First one we're going to get coming up this year will be February 1st. So we'll have to wait and see how many more they're going to continue to do and how they affect the market overall. But they still have some room. Now, they're saying the terminal rate, right, which is where the Fed's probably going to end at. Right now, we're at 4.25%. For a while, that terminal rate was above 5%. They were thinking between 5 and 5.5% is going to be somewhere where they land on rate hikes. But now, as of today, it's saying 4.89, so just under 5. I still think we're going to hit the 5 level. We'll see. You had your boy Jamie Dimon come out the other day and said, we're going to see 6% rate hikes. Well, I don't know. I thought he was crazy for some of the stuff he said last year, at the beginning of the year. But turned out he was right. So this is a guy who's been in the business for a while. You got to listen to him. I mean, but nevertheless, CPI is causing the market to sort of jump up because it's been, calming down, which means inflation is calming down, and overall it's a good thing. So does this mean we're going to see the next bull market start? I don't know, but there's a lot of bullishness out there right now, I would feel. I don't think today is reflective of it. But when you look at certain market internals, or you look at volume, when you look at where we are as far as technicals trading, we're right on that 200-day moving average for the S&P 500 and the SPX. I think those are some of the reasons why people are starting to get a little bit excited. Not to mention, you talk about some of the other things. Look at gold. Gold's over 1,900 for the first time since May of last year. Gold has been a boring trade. It really hasn't been interesting at all, not to me anyway. But I did have some GLD calls heading into this event. I'm sure some of you saw it. We can talk about that when we get to the platform a little bit later on. But gold has been kind of boring. Hasn't really been that interesting over the past year. Now, all of a sudden, it's starting to get to a level where maybe it's interesting. The dollar's starting to fall. Of course, that leads to a lot of other different dominoes changing in the trading landscape. And Bitcoin. Look, Bitcoin has been very, I don't know how you put it, ugly. And you haven't wanted to touch it, honestly. But now it's over 18K, and it's knocking on the door of 19,000. And this is the first time we've seen it this high since the whole FTX blow up, which is really what kind of made people a little bit scared. Nobody's wanted to touch any of the names. Nobody's, the equity names like the MicroStrategies of the world and whatnot. Wow, MicroStrategies, $207 again. And some of these names are starting to perk back up. MicroStrategies, Silvergate, which got rocked on earnings last week, is starting to perk up. Coinbase is starting to find its way. So these are starting to become pretty interesting and kind of compelling. Bitcoin is at this level again. And I think that's good for the market. We kind of need that. Leftovers. Kids are getting outside a little bit more than before. Let's move ahead to the next slide. This is a chart of the amount of hours that kids spend playing out time. Now, pre-pandemic, on average, it was about 13.6 hours you play sports each week. There's a lot of people who contend that kids don't do as much these days, right? They're all on the iPads. They're all kind of indoors. Things are different. There's not as many situations where you got the whole neighborhood of kids just outside playing like many of us grew up. Yeah, it's fairly true at times. I tell you, it definitely changed during the pandemic. Look at that. June 2020 and September 2020, about 7.2 hours, way down, obviously, for obvious reasons, right? Then you got to April, I think things started to pick up again. 12.2 hours playing sports each week. I remember it was in the spring last year, but it was definitely in the spring of 2022. Where you'd drive by any field and you'd see sports going on. It was like an overdrive, man. And I feel like we've kind of headed back in that direction. As of September of last year, 16.6 hours, so well above the pre-pandemic level. So what's the take home here? Get the kids outside, get them playing sports, get them doing something. It's better for them. It's better for the mental health. You're starting to hear all kind of weird stuff about different kids and things that, I don't know. It's not a good trend. Just get them outside, get them playing sports. You learn so many things the kids learn from that, right? The interaction they have with other kids is top notch. You learn where you lie in the social structure of America or whatever, and whether in America or whether in the UK or wherever you are. You learn where you lie as a kid. And I always feel that it's a better thing when you're playing sports with like other kids, you learn how to be a part of a team. You know what I'm saying? It's a huge thing. I think it's good. Speaking of, I got practice tonight. I got the second league that I'm coaching. I'm coaching 2 basketball leagues. I'm going to talk about this a lot because I need to sort. You guys are my therapists. There's going to be a lot going on in these teams. We had practice on Monday. That was pretty interesting and fun. This one little kid, he thinks he's John Morant. It's hilarious. I mean, he goes up with these left-handed one-hand scoop layups. He tries to play just like him. It's the funniest thing. And that's going to be really entertaining watching these kids. And then, I got another team I'm going to be on. Our first practice is tonight. But I'm coaching with friends, so that helps. It's going to be fun. Anyway, let's move to the next slide. So now, looking at the CME FedWatch tool, you can see the Fed futures is pricing a high likelihood of a 25 basis point rate hike in February. It was about 60 to 70% chance over the last couple of weeks, but now it's a strong 90%. And CPI, Christopher Carlson's asking, what's CPI? By the way, those of you who are watching the show, if you're watching on the Tasty Live website or watching on the Tasty Live app, come on over to the Tasty Live YouTube page. Sent out a link for it earlier on Twitter, but we of course have the chat in here. Jump in and ask chat questions all the time, or just chat amongst each other. It's all good. I'm watching you, I'm listening to you, and I'm going to jump on in. Yeah, Consumer Price Index is CPI. That's exactly what that is. It's a measure of inflation and how high inflation is in our economy. The highest it was more recently was, I don't remember if that was March or April, but it was about 9% last year. It's the highest we'd seen since 1981. And like I just recently said, over the past 6 months, we've seen that metric come in. Now it's year over year, and it's still increased. It's still high, right? Still 6.2% or 6.5%, I think. But it's way down from what we were several months ago, 7 to 9 months ago, right? Which is good. And we've seen incremental decreases over the last several months. So now, because of that, we're still going to have a rate hike, as it shows here. It's just not going to be a big rate hike, right? We're currently at 4.25 to 4.5% on the Fed funds rate. We're probably going to get another 25 basis point hike, which this is showing us. There's a 90% probability that we get another 25 basis point hike. That's different than what we were getting early last year. Between, June and November, we got 4 75 basis point rate hikes, right? But I think the Fed now is going to calm down. So we're going to stay what they call higher for longer, which means we're going to stay at this somewhere between 4 and 5% on our Fed funds rate for probably most of this year, if not all. They're probably not going to think about cutting until next year. Now, all of this doesn't matter if some other new thing happens in the market that we just did not prepare for. That's when you see markets tank. That's when you see VIX go up because of some new unforeseen sort of volatility event that may or may not happen. Those are the times you see that. Other than that, there's no worry about volatility now. As a matter of fact, the thing that's kept volatility up most of the past year, remember, 2 things. One was Russia-Ukraine war. 2 was rising yields and rate hikes, and we had no idea where the Fed would stop, where they would stop. And now that we kind of see an end potentially in sight, it's a little bit different now, a little bit different. Let's move to the next slide. Grumpy Mike, I see you, buddy. You're talking about what ages on playing outside. You know what? That survey didn't have ages, but I don't know. Let's just go with kid ages. I don't know. Somewhere between 6 and 13. How about that? We talked about gold. This is the reason why. Look at the dollar. Dollar was on a tear last year. We know that. And it particularly got really ugly for gold in the later months of 2022. But as dollar started to fade, we're starting to see gold sort of reassert itself. And so I guess when you ask yourself, do I want to put on a gold trade or not? Well, you have to really ask yourself, what do you feel about the dollar? How much lower do you think it's going to go? Of course, the dollar being down is making gold a little bit bid. It's making, oil to some degree a little bit bid. I mean, I think a couple of things affect oil at times, whether it's more supply and demand related. And of course, the dollar being down is affecting all the currencies. You got the euro up, you got the yen up, you got the Aussie dollar up, you got the Canadian dollar, the loonie up. So the dollar coming down has been beneficial for a lot of different things. And not only that, it's been beneficial for markets. I mean, half the time last year when the market was going up, as you can see, this not only gold, but stocks made lows around November, December last year. October, I should say, through December, the stock market was pretty ugly. So dollar being down is good for a lot of different things. It's also good for companies who do business overseas as well. But gold will only go as far as the dollar will allow it to. How about that? Let's move ahead to the next slide. Volatility is just blah right now. It just is. I mean, the VIX is 19. As a matter of fact, one of our polls that we had on here the other day was, what do you expect to see first? VIX sub 20 or VIX over 24? Now, today really changed that narrative, because if we had some crazy number today, markets would have been down, VIX would have perked up, promise you would have been around 24, but didn't work out that way. VIX is below 20 now, sitting on 19, looking like it wants to go below 19 towards the end of the day, honestly. And so this chart is something we often look at. It's what you call volatility risk premium. It's the difference between the VIX and the 30-day historical vol. And so it's basically expected volatility minus volatility that we actually saw already. You can do this with a lot of different things. In this case, we're doing this is a way of looking at the S&P 500 as a whole, right? Because the VIX is the implied volatility of the S&P 500, and then we look at the 30-day historical vol of the S&P 500. So when you're looking at these two metrics, when you subtract that historical vol from VIX, this gives you an idea of if it's a good time to sell volatility or not. And basically, it's not really. Right now is not the best time to be selling volatility. As a matter of fact, I don't have too many different short vol things in my portfolio, and I might close out the few that I do. We'll get to that in a little bit when I look at the portfolio, but it's not the best time to sell volatility. You might want to wait for better levels, and you also should be aware of your cash levels. So I think most of the things that I have right now are long calendar call spreads. I am short vol in the near term, short upside, and I'm long upside in a further out term. But in that near term, it's January. It's about to come to a close in a little bit. So yeah, selling vol is kind of blah right now. So keep that in mind. Don't feel the need to rush out there and sell a bunch of vol. It's probably better to either, you can see most of the things that we look at. You can look at a lot of the ETFs that we look at, whether it's S&P 500 sector ETFs. Most of them are low vol right now, very low vol out there. So you might want to wait for better levels. There'll be other times when VIX will perk back up, whether it's 22 or 23. It'll come. It'll happen. I think it'll happen. It should happen. We still have somewhat of a volatile year left ahead. It's not like 2017 where we basically just went up all day, every day, or very little bit, but the market, but the VIX basically didn't move, and it was fairly low. It was like a 12 or 11. I think in 2017 the low was like 9 something. It was under 10 for one day. I don't know if it closed there, but it was nuts. Very quiet year. I don't think we're going to have that kind of year. But anyway, vol is blah. Let's move ahead to the next slide. Earnings. We can take a look at a couple of bank earnings that are going to get started. JP Morgan, Wells Fargo, Bank Mellon, and BlackRock. And then we can look at airlines. AAL had earnings today. I think they did well, so we'll see what Delta has to say. And then UNH. And then, of course, markets are closed Monday for the MLK holiday. Great man that he was. It should be. You know what I'm saying? Let's move to the platform. Let me take a look. What we got? My people in the chat, where you at? Why is the dollar getting weaker now? Well, it's been the rate hikes, mostly. It's been the rate hikes that have sort of started to bring the dollar down, and it's just time. I mean, is the dollar going to go up forever? No, it's just time for the dollar to go down. You know what I'm saying? SM. Who's buying SM? I do know that name. Isn't that an oil name? SM. Yeah, SM Energy. I remember that name. Anyway. SPOOs kind of faded a little bit as we've been on talking, but still holding 4,000. NASDAQ up 0.4%, and Russell 2000 has been strong, 1.5%. It's been really strong over the last couple of days. You don't want to get in the way of this thing just yet. 2-year yields, 5-year yields, 10-year yields, 30-year yields, all down. You don't really see that too often. All durations of yields are down, but inflation is calmed down, and it's causing these yields to sort of back the truck up just a little bit. You do wonder about this 2-year yield, though. If our terminal rate is going to go, I wonder if we've seen the highs in yields. I don't know. I know these are futures, right? And so 2 years from now, you got to think, if our terminal rate's going to be around 5%, why isn't the 2-year yield 5%? Well, 2 years from now, we might be looking at rate cuts. So this is the future, right? You got to think about that in that terms. And so that's one thing to keep in mind. Talk about inversion. This is still about just under 60 basis points between the 2-year and the 10-year. That'll be something when these actually line up once again. That's how you know things will be interesting. But everything else is seemingly in line. I mean, the 10-year is still below the 30-year, so that's probably good for global growth overall. Volatility is in. You can see the VIX. Let's go to the. This is the January VIX, 20, just above 20, I should say. This thing might close below 19 sooner or later. And then you got February VIX trading 21.45, And you got March VIX trading 22.45. So volatility is pretty darn low. This is exactly what we're talking about. If you didn't believe me from the volatility risk premium chart that I showed you, then you can certainly believe that looking at the term structure of the VIX, things are fairly low right now. Not the greatest selling environment. Crude oil is trading around 78.50. Like I said, I've talked about this on Futures Power Hour. 80 is fair for me, and crude is very fair right now. Volatility is low. No interest in any kind of trade. Moving on. Nat gas has been kind of crazy, of course. It's just been dumping over the last several weeks here. And volatility is high. Wouldn't be, I wouldn't kick you out of bed for eating crackers if you decided to sell some volatility in here. I could see selling a Condor. I was looking at it myself. I don't have anything on right now. I'm not really interested, but I would support you if you wanted to do that. Look at that, 330 on an Iron Condor, selling those. It's not a bad trade at all. It's not a bad trade at all. Bitcoin, one of the stars of the hour, trading above 18. Look at that big bar on Bitcoin. Look at all that volume. Boom, it's doing it today, man. And again, it's right back. It's above this one of these. Well, I feel like this was a 2-day breakdown for FTX, but still, it's above the first tranche right here. And so, who knows when it goes to the next? If it gets to 20 in short order, that'll be fairly interesting there. And Bitcoin overall just seems to be reasserting itself. But that's actually one of our questions in the chat. Bitcoin's back above 18K. What are we thinking? Still overpriced? Is it time to get long? I've been in already. What are you talking about, Jamal? Or you don't care? So far, 37% don't care. That's where it is right now. That lets me know that it's not at a level where it's in the zeitgeist yet. I think 20 is that level. If it gets to that, I bet people start to care again. You watch how these things work. I know how FOMO works. Watch. Just watch. Ether, 14K, also making a big move. So cryptos are starting to come back a little bit. And then here's gold, like we said, touched 19 today. Enough of that. My trades, where are we at? So couple of things I've done today. Within the last 24 hours, I did have an SPX downside butterfly with the short, the 3,900 strikes, just in case we did some craziness today and we got down below. Didn't quite materialize, though, which is fine. It was just somewhat of a little hedge because I felt like most of my deltas were fairly long. I still have as far as near-term trades, I still have the calendar and Apple. It's a 20 strike. It's pretty far out of the money at this point, but I'm still holding it. I might need to readjust this. I might want to readjust this and do the 25 strike, just in case we do have some changes. Maybe I do. I think I do. Well, if I close that out, I'll get it. And I'm going to do the 25 strike instead. I still want some short delta there, especially given this moves in the market. Netflix hasn't changed. UNH is still the same. UNH has earnings tonight. This is one I got to keep an eye on. Where are we at? The 497 half. Oh, look at that. Perfect. $13.05. What's that, people? What kind of expected move is that for UNH? UNH was one of the stronger names coming out of last year, but it's been tough to get its footing over the past couple of weeks. It's one of my long call calendars. It's kind of caused me some trouble recently. I don't know what I'll do with it. 2.6% is the expected move. I'm not going to touch it. I'm not going to do anything here. I'm just going to hold on to it. I'm still basically, at that point, those are way out of the money, the January 490 calls, and 540 calls, and then my upside is 540 as well in February. So I will be looking out for that for earnings. As far as other earnings, of course, the banks are the big one is JP Morgan. I don't think it's pricing a huge move. 140 strike, 415. What is that? I just can't seem to do the math that I want to do in my head these days. Calc, come on, baby. $4.15 divided by 140. Think fast, quick, fast. They used to do that to us all the time when I was trading. 2.9%, almost 3% move expected out of JP Morgan. Vol is not particularly high. I don't have anything I'd be interested in doing this. When I look at the chart, I'm not particularly excited. If anything, maybe I'd buy a put spread just because the chart looks a little extended. You know, maybe that's something I do, but honestly, I don't have a desire to really do anything in this thing. Imagine it being down $9 tomorrow. Do I want to do this? Heck yeah, maybe I do want to do this. I don't know. 290? Yeah, why not? Let's do it. I don't know. That's probably not going to work, but whatever, man. It's a decent trade. That to the file. I always got to remember to like publish these. Sometimes I forget to do this for you guys. I did that SPX put butterfly, and I totally forgot to post it yesterday. So just bought a put spread in JP Morgan for earnings. We'll see what happens. What else have I changed? So some of you may remember I talked about these a while ago. I've had them on for a while. Wow, it's still going higher. Carvana and Triple BY are two of the largest short interest names in the world right now, it seems like. So I thought it would be fun back in December to put on some deep in the money calls in the event that they had a short squeeze. Lo and behold, they've had a short squeeze. So I just closed out some Carvana. I'm probably going to close out some of the Triple BYs too. Yeah, kind of did a spraying of calls across several different months. Again, these are super in the money. Yeah, it's working out so far. It's just a play on craziness. But I'll probably close out. I closed out my Carvanas earlier, and I'll probably close out my Triple BYs now. It's probably time. Or at least one more. You know what? I'll do one right now. Let me close out the Marches. Keep the ones that are further out. Can I do 385? Will you let me do that? 385 offer. Look at that. See? That's me. That's me. Say hi. Well, folks, that's it for all the fun here on today's Engineering the Trade. Thanks for watching. And as always, be smart, be patient, trade small, trade often. I'll see you guys later.
I used to be disgusted. Now I try to be amused. But since the wings have gotten rusted,